I'm Mike Conlon. I'm one of the senior instructors with the courses. Welcome to today's blog. Today's blog is entitled, Not So Fast, Bernanke. Yesterday's claim that the Great Recession in the United States may be over is nothing more than an exercise in semantics. While it may be technically true, as a recession is commonly defined as a decline in gross domestic product for 2 or more consecutive quarters, until we actually see positive GDP growth and no more less negative GDP growth, I for one will not be breaking out the party hats. All right, the last GDP report showed that in the second quarter, GDP declined at a rate of about 1%. Right now, compared to the 6.4% that we saw in the first quarter, this number seems pretty good. While many economists will point to this figure as a sign that the economy is stabilizing, I'm not so certain that this uptick is the start of a new trend that will put us back on a path to recovery, or if it's just a pause, a pause that happened in what's become a clear downtrend. Now, there are many factors out there which do not bode well for a quick recovery for the economy, and Bernanke and all are in a difficult position as they have to pick their poison, so to speak. All right, let's take a look at a few areas that could rain on the recovery parade.
As always, be sure to check out the written blog at www.mywealth.com/blog. Okay, the first area that we want to take a look at, which could further delay the recovery, is continued unemployment. Right now, unemployment is perhaps the single greatest factor and impediment to recovery. So even though unemployment, it's still rising, but it's happening at a slower pace. All right. Even the administration and Bernanke himself has anticipated a prolonged period of high unemployment, and it's likely going to exceed 10% by next year. Okay, now why is that important? Well, because we really need the consumer to come back step into the economy and start buying stuff so that we can make more stuff, so that the money can get flowing, the economy can get back on track. Okay, the consumer represents some 70% of GDP, and that's a very large figure. So if we don't have the consumer on board, if people don't have jobs, if people aren't making money, if people aren't confident making purchases, then that's going to stall the economy and the recovery going forward. Okay, the next thing we want to look at is further residential and commercial real estate defaults. Okay, now there has been a little bit of a bottom put in here at real estate, but we're not certain if this is going to be a temporary or if it's a permanent bottom. Okay, the commercial real estate market right now is in dire straits, and it hasn't even really been touched on. Right now, we've been dealing with primarily residential defaults, and that's where the bulk of the government money's been going. All right, it's going to shore up the banks who can now absorb some of these losses. That they're going to be able to recover. But when you talk about commercial real estate, that's a market that hasn't even been touched on. All right, now if you don't have a lot of people starting businesses because banks aren't lending money, that's a lot of office properties that are sitting empty. If they're sitting empty, that means that the owners aren't making any rent, they're not selling, so they can't meet their mortgage obligations, and thus the spiral continues. So it's really going to be interesting to see what happens with real estate. Okay, if we continue to see defaults and more losses, okay, this could put a whole new glut of properties on the market, and that could further depress real estate prices, which would then put a whole new group of people underwater, and it would continue with that asset deflation that Bernanke and the Fed have been trying to avoid. Okay, the next thing we want to talk about is that the banks are still not lending. All right, even though we have a very low inflation rate right now, numbers just came out this morning, roughly 0.4%. The banks still aren't lending out their cash to folks. What they're doing right now is they're trying to shore up their balance sheets. Okay, so they're borrowing the money at this very, very low rate. Okay, but they're not actually putting it out there for the public and for consumers to use. Okay, because what they're trying to do is they're trying to get their balance sheet shored up. All right, so they've tightened lending standards to the point where the only folks who can really get loans are people who don't need them in the first place. So John Q. Public's having a hard time going out there and getting money to finance their purchases if they are looking to make those purchases. So that's something that that's going to have to change if we're going to move the recovery forward. All right, there's also future inflation concerns. Now, we've talked about this before, the difference between deflation and inflation. Okay, and I think we're seeing a little bit of both here. We're seeing asset price deflation, okay, which is real estate prices that are coming down, okay, and we're trying to avoid commodity inflation, which is things like your food and your energy costs going up. All right, so there's a fine line that the Fed's got to walk there, and they're trying to balance it. All right, but what we're worried about is that because the assets are so far underwater, okay, can we inflate it to the point where it's going to get back to a little bit of normalcy, okay, without causing commodity inflation to incur, which is going to affect the economy overall. So the key is going to be how they go about balancing both asset price deflation and commodity inflation. And the last thing we need to happen is consumers must have amnesia. All right, it's not going to be long before the banks do shore up their balance sheets and they're going to start lending again. But it's going to be interesting to see how many consumers bite. Okay, because right now, like the banks, consumers are also attempting to shore up their personal balance sheets. All right, and they've been saving more than they've been consuming. All right, now you go out and you see people say, I've heard my wife's friends say things like, "Oh, we can't afford this right now," and I used to never hear that. People would just throw it on the credit card, put it on the plastic, and worry about it later. So I think people are really making a commitment to get their balance sheet shored up, which is a good thing. All right, but if they're hesitant to step back into the markets to buy, then that could be a bad thing. Okay, one of the big problems, particularly, is going to be with the housing prices, okay, and with other big ticket items. That we just had these government programs which are out there, the Cash for Clunkers and the refrigerators deal and the first-time home buyer rebate. If people aren't quick to jump back into these markets, then that could cause further price deflation. So that's going to be something that we're going to have to see, because if we do get commodity inflation, but we get asset deflation, all right, will the Fed raise interest rates? And if they do raise interest rates, will that further depress housing prices? So it's an interesting situation here. All right, so don't wait. Get educated, get in a course. Come to www.mywealth.com and learn about how the economy can really affect your investing.
As you can see, Bernanke and the Fed are in a bit of a conundrum with regard to how to manage the economy going forward. In essence, they're in a damned if they do, damned if they don't scenario. While the steps they took may have staved off the Great Depression 2.0, they really want to be careful that we don't end up as Japan 2.0. So while the most recent economic figures may be encouraging, I'm not ready to call us out of the woods just yet. A lot of these figures can be directly attributed to the stimulus packages, and once that stimulus runs out, will the economy be back on track? If they pull the trigger too early, we could fall back into recession and possibly depression. If they leave stimulus in place too long, we could see a much greater erosion of the U.S. dollar, and we could see even more unfathomable U.S. deficit, as well as a further crisis of confidence both here and abroad. Okay, all we can hope for at this point is that Bernanke can walk the walk and not just talk the talk. To learn more about the economy and how it can affect your investments, be sure to check out our courses. So I'm Mike Conlon. Thanks for being with me, and I hope to see you in those courses.